There's some odd things going on in the housing market right now. Hi, my name is Chris Gorman, and I'm going to tell you about it in this fall market update for the Triangle. So first, let me run through some numbers with you. In Wake County, now this is the end of August, okay? This data always lags a couple of months. Inventory was up 57% at the end of the month over August 2023. So 57% more homes at the end of August this year than last year. Inside that number, new construction was up 31% year over year, and resale listings were up 78%. That's a big jump year over year. Listings with at least one price reduction were up 90% year over year. Closed sales year over year down 9% in August. Now, all that going on is pretty bearish. Normally signify prices are probably on their way down. However, average sales price in August was up 5% year over year. How can that possibly be? Well, the main reason is still supply and demand. Now, we've talked about some numbers that indicate supply is on the rise, and it certainly is. However, demand is still strong. People are still buying homes in our area. And a lot of the people that are buying homes in our area are not selling homes in our area. They're either first-time home buyers moving out of an apartment, or they're buyers that are relocating to our market from somewhere else. So while they're consuming our supply, they're not adding to it. We have a lot on the supply side before we start to see the scales of supply and demand turn prices negative. So prices are still going up. We still have this situation though, where we have a lot of locked up inventory, just stagnant, right? People, you may be one of them, with a very low interest rate on their mortgage, just can't stomach the idea of moving into another home and trading a 3% interest rate for a 6%. Now, 6% is a lot better than 7 or 8 that we saw earlier this year. So rates are definitely on the way down. However, I think we've still got at least another percentage point for interest rates to fall before we start to see any sort of tangible, measurable movement in that locked up inventory. Having said all that, there's this one X factor out there, and that's new construction. As we sit here today, new construction makes up 49% of the active listings in the Triangle MLS. And there's a higher concentration of new homes in Wake Forest, in Wendell, and in Fuquay-Varina. Builders are building in those three locations at a higher rate than they're building anywhere else in the Triangle, mainly because of affordability and price points, but regardless, that's where it's taking place at a higher number. A lot of these builders are national builders. You've got the smaller builders out there building small subdivisions or one or two homes, but the majority of that new construction is national builders, okay? And national builders have sales quotas to meet. Now, there are other parts of the country right now where the real estate market is not as healthy. Florida is one, certain parts of Texas. These national builders have to hit their national sales quotas. And so a lot of times what happens if one part of the country is suffering and they're not moving as many units, what they'll do is they'll try to compensate by moving more units in another part of the country where the sales are better. And one of the ways that they can do that is incentives or price cuts. While we haven't really seen it yet, it's possible that as we move towards the end of the year, we might start to see builders drop their price in order to get more units moved by the end of the year. Now, when new construction makes up 50% of the market, if new construction moves, resale has to react. If you've got two homes that are identical, the only thing being this house is 5 years old and this one is new construction, everything else is the same, and they were priced the same, which one is the buyer going to choose every time? They're going to choose the new home, right? So what does the resale home have to do in order to attract the buyer? Well, normally they have to be priced below the new construction home in order to incentivize the buyer to come to their home. So if the new construction price falls, then the resale will be pushed down by a commensurate amount. And new construction is absolutely driving our market right now. It's really tough for the resale gang to keep up with the incentives that are being offered in new construction. We put a buyer under contract last week that locked in a 3.99% mortgage rate. Okay, so think about that. Rates right now are about 6.25%, maybe a little less than that. That's significant money, and so the builders are just buying down the rates, and so all of a sudden a home is affordable to somebody where in a resale situation it wouldn't be. So they're absolutely controlling the market, and if they make any sort of adjustments, then that will send a ripple effect through the entire market, especially in those three geographic locations we talked about. That 400 to 700,000 price point is kind of their sweet spot. So if you're in that subsegment of the market and you're thinking about doing something in the next 3 to 6 months, you may want to have a conversation with me so we can talk about how that might affect you. In general though, so talk through a lot of numbers. What do you need to know about the real estate market in the Triangle? It's still moving, right? Prices are going up. You're going to sit on the market a little bit longer than maybe a year ago or 2 years ago. Definitely more than 2 years ago. 2 years ago, it was a day. 30 to 45 days is a good planning kind of budgetary number. If you're trying to make a move, you can expect your house to be on the market somewhere between 30 and 45 days. Now, that's not all the time. There's obviously exceptions to that, but if I was selling right now, that's kind of what I would plan around. Still a great time to be in the market though. We're in a rising price environment, so theoretically anything you buy right now is going to be worth more next year, and we should be dealing with lower interest rates next year if the Fed continues to execute on the plan that they've laid before us, which is several rate cuts over the next 12 to 24 months. Now, one thing that people have asked me about rates, a lot of you saw the Fed meeting from a couple of weeks ago where they announced they were going to do 50 basis points cut to the federal funds rate and possibly another 50 before the end of the year. Everybody was looking at these mortgage rates saying, why hasn't it hit the mortgage rates? Well, it did. It just came well before the Fed announcement, because these things are always priced in advance of the Fed making a move. Somehow the markets know what's going to happen before it happens. And so these rates, they move before the Fed announcement. So right now, mortgage rates are trying to anticipate what's going to happen next month, 2 months, 3 months from now. Remember, mortgage rates are not linked to the federal funds rate. They're linked to the 10-year treasury with a spread. So mortgage rates are going to follow what the bond market does. And if the bond market prices go up, then mortgage rates go up. If the bond market prices go down, that's what causes mortgage rates to go down. It's all tied together, but there's no direct link between the mortgage rates and the federal funds rate. If you're watching the economic news and you're watching CNBC and you're waiting for Fed Chairman Powell to bring rates back down into the fours, he can't do that. He can certainly impact that, but he can't do it directly. And I honestly think that if rates are right now just above 6, I think they'll probably have to get another full percentage point lower before we see inventory really start to get unlocked in the market. So low 5s. And I think that there's a pretty good chance by the end of next year, that's what we'll be looking at. And so just keep that in mind as well, because you can buy something now while prices are going up, lock yourself into a price, and potentially refinance later into a lower rate. I say that with the caveat, don't do it if you can't afford it. Only do it if you can afford it. And if rates drop in the future, you could potentially save some money on that mortgage. But we're starting to see more and more people get into the market that weren't in the market last year. They're outgrowing their homes. They're hitting the pain threshold. They're saying, you know what, I don't care if it costs me more. We've got to get out of this situation, or we've got to get into that situation, whatever the case may be. And it's going to be interesting as we go towards the end of the year to see what happens in the new construction market and if that has any impact at all on the resale market. If you have any questions about any of this at all, drop it in the comments below. I'd love to engage with you. Otherwise, I will see you next time.